This week sees the belated release of the US jobs report, with the Friday release instead pushed back owing to the US shutdown, which has been resolved, albeit for the time being. So let's look into the data, see how it could impact things, especially given the backdrop of a new Fed chair expected to come into place in May. So kicking off with market expectations, you can see here there is a prediction of yet another weak reading on the payrolls front, down to 40K from 50K, with unemployment moving higher to 4.5%. So more weakness with the jobs market expected. Then when it comes to average hourly earnings, expected to pretty much remain as is, 0.3 on the monthly, 3.8 on the year-on-year figure, and a decline in terms of the participation rate. Now, one thing we have seen for the week just gone is the release of job cuts data from Challenger and job openings data from Jolts. And neither of them make for great reading, quite frankly. A sharp decline in terms of the Jolts job openings figure and a sharp surge in terms of job cuts. So we're already seeing indications of weakness around the US economy, particularly the jobs market. And I guess for many, they've got to try and ascertain exactly whether this is weakness of the economy as a whole or whether this is just a jobs market issue. Is this to do with some of the moves they've been making with ICE and the migration issue? Is this an AI story? Is this something that is going to be counter to the evidence seen for companies? Like a company's going to do well, but people aren't, because they're going to be able to sort of make significant cuts, bring down costs, especially owing to the AI revolution at the moment. These are the major questions in play here. But of course, we've now got Kevin Warsh potentially leading things in terms of rates and monetary policy. Over the course of the weekend, we heard of a potential accord between the Federal Reserve and the Treasury, which points towards greater influence from the likes of Scott Bessent and Donald Trump when it comes to policy making. But certainly, I think there is a potential for a more dovish outlook from the Fed under Warsh than many had anticipated when they first started hearing it. But inflation needs to be under control. The jobs needs to be a concern, and growth needs to be a target. Certainly, I think he looks to be a pro-growth governor in the making. In terms of the non-farm payrolls figure, if you compare it against the US dollar index, this kind of gives you a good idea of where to go from here, according to how the jobs report looks. If we see weakness in terms of jobs, whether it comes through a low payrolls figure, whether it's a rise in unemployment, generally that is negative for the US dollar, because it calls for additional easing from the Federal Reserve in response. And we've seen that in the past. It's not necessarily immediate always, but generally the path is determined by exactly what happens in terms of this jobs data. So if we do see weakness, that's a potential driver of downside for the dollar across the board. Now, this time around, we also get to see the annual benchmark revisions, so essentially all of these numbers that we see in terms of the payrolls generally are sort of preliminary figures. They're for small sample sizes. And at the end of the year, you then get a major revision on top of the smaller revisions that come over the course of the year. The preliminary estimate was minus 911,000. Then we've seen an estimate from Jay Powell, which is roughly 600,000. You can see it here in the context of previous years' downward revisions. Either of those would be pretty hefty in size. You can see here that the downward revisions, where we've done it on a sort of month-by-month basis, which often happens, you'll see this figure and you'll get a revision to the prior, have pretty much all been down over the course of the past year. So certainly that's another element to play into whether this is seen as a weak or a strong report. The average hourly earnings figure is an interesting one, because by and large it's been viewed as a proxy for inflation, because we need to see wage growth ease off a little bit to be able to keep a lid on inflation. However, I think there's a perception under Warsh that they want people to have strong wage growth. They want people to be able to spend more. They might deem it inflationary in normal circumstances, but essentially with everything that's happening in AI. They see that as being very deflationary. And in actual fact, I think they're right on that front. Quite how long it's going to take to kick in remains to be seen. But certainly where people are replacing humans with AI bots, essentially, that is a lot cheaper, so they can lower their prices. Where you're seeing the sell-off that we saw over the course of the past week around the software sector, that really was about the idea that these companies charge a huge amount of money for products that AI is just going to be able to create something very similar in no time at all. Again, deflationary for certain services going forward. So in actual fact, I don't necessarily think that sort of strong wage growth is going to be viewed as a major concern in terms of inflation down the line, if they think very heavily under Warsh that essentially the disinflation is pretty much guaranteed with everything that's happening in terms of AI. In terms of the breakdown for the jobs report itself, or for the payrolls figure itself, you can see the weakness that's been evident of late really highlights the fact that this is just a case of an economy where the job creation is only really coming from a small subsection of the economy. You can see here that it's education and health services, which has been strong for a while now, pretty much under Trump. That's been the leading part of it. But alongside that is leisure and hospitality. Many of the other segments of the economy shrinking, notably the manufacturing sector, which they essentially thought they were going to bring a boom to US manufacturing through the use of tariffs and the like. It's not happening at the moment. In terms of market expectations for the Fed, here's the CME's outlook as things stand. No cut until essentially we get a new Fed chair. That's in June. Then 75% chance of a cut for that meeting. So people are confident that Warsh is going to be able to move the needle when he comes in terms of getting the group to vote for a cut. And now progressively, people are calling for a second cut at the back end of the year. And you can see here the shift in expectations over the course of the past week has notably swayed more towards the idea that by June we're going to see a rate cut, and also that we could see two, which seems unlikely, but this is just talking about sort of outside pricing. So markets clearly are starting to shift in favor of the idea that Warsh isn't so hawkish after all, whereas when he first got nominated, there was a bit of a freak out, most notably within the precious metal space, because they thought that we suddenly had this super hawkish Fed chair in the making. People waking up to the idea that might not necessarily be the case. And certainly with the weakness in terms of the challenger and the jobs numbers and the JOLTS numbers, that sort of pushed things further in that direction towards a more dovish stance for the Federal Reserve, or perceived dovish stance from the Federal Reserve. And of course, then that brings market implications, the potential for weakness for the US dollar, for example, or strength for the price of gold. So talking of which, let's look at some markets and see exactly how things are shaping up as we lead into this report. So first and foremost, this is the Dow. We can see that the Dow has broken through resistance and got through the 50K mark. Here things are on the long-term perspective. It's been a very strong move higher over the course of the past year. And notably, whilst we saw that sharp decline at the beginning, now people are kind of getting on board really about the idea that, Trump and his sort of policy mix will be very good for the US economy. Of course, he's trying to bring jobs back to the US, that many of these jobs people are saying the US doesn't need these jobs. They don't want to make a shoe and things like that, right? But I think given there's the midterms coming up, there is a need, and certainly we've heard it from a number of these different Fed chairs, probably because they've been having conversations with Trump and they know what he wants to hear. But Rick Reeder said the same thing, and Warsh is saying it now. Essentially, the benefits to people in the US have been lopsided. It's in favor of the asset owners and not people that are working paycheck to paycheck. They need to help the people that are working hard, but maybe feel like they're being left behind. Those are the kind of people that they need to win the votes over for. So there's a few that under Warsh, it's going to be less in favor of Wall Street and more in favor of Main Street, so to speak. And that should benefit traditional industries, many of which are wrapped up within the Dow. So I expect to see outperformance for the Dow. I mean, if you look at things over the years, let's go on to the weekly, and then we'll just create a ratio. So we'll say the Dow divided by the NASDAQ, right? I would expect this to be a new price scale. There we go. So the downward trajectory shows you the underperformance of those sort of traditional companies compared to big tech over the years, right? But things are turning up of late, and this really highlights the shift in narrative that we've been seeing of late. And I think this is going to continue. I think ultimately people, like we've seen recently over the course of the past week, people are becoming fearful about what the implications could be of AI. Yeah, tech companies seem like a good place to be when everyone was going to gain from AI, but what if it's going to put some of them out of business, like software companies? So there's significant jitters around that. There's jitters around overvaluation in the tech space as a whole anyway, even for those that are potentially going to benefit from AI. And so I think whilst we're used to certain price to earnings ratios being allocated to certain types of businesses with a certain growth rate, I think generally that type of business, because of the perceived relative safety that they provide and the repeatability and of their growth and their profits and the moat that they've provided, means I think we're going to get higher multiples attached to them. So I do think that this index is going to continue to do well. At the moment, it's been doing very well, in particular against the tech stocks. You know, that is going to come and go, quite frankly. It's not to say forevermore now the Dow's going to outperform the NASDAQ, but irrespective, I think it's in a good place at the moment. I think people are waking up to the value of investing in maybe something a bit more boring and reliable, but something that's going to be less impacted by AI. And so, yeah, we've broken up towards the upside. If we see a breakdown through this near-term swing low, 48459, then things start to look different. But until then, I remain bullish for the Dow. In terms of, let's go on to the US dollar index, look at that sharp decline. This comes off the back of the weekend talk about this accord between the Federal Reserve and the Treasury, essentially calling into question the independence of the Federal Reserve once again. So people thought that Warsh was this massive hawk. Well, that story is starting to go away a little bit, and the repricing towards additional rate cuts that I've shown you on that previous chart really playing into sentiment here for the US dollar. Let's just put on, say, the US 2-year yield and see what kind of correlation we're tagging up on that. So, yeah, so expectations of where rates are going, you know, things starting to roll over. So the 2-year sort of has a close correlation with the perception of where rates are going from the Federal Reserve and near-term rates. So as that heads lower, so you would expect to see further downside playing out for the US dollar, and that's what's happening at the moment. So yeah, the bears are back in charge for the US dollar, the dollar index at the moment. And certainly if we see weakness in terms of that jobs report, that sort of reiterates and furthers that narrative once again. You can see here, slap bang on that 61.8, then the breakdown through your first swing low, which takes place here, is your confirmation, 97.3 essentially. And we're sort of pushing on from there. So yeah, the bears back in charge here for the US dollar. And then looking at things from the perspective of gold, let's just look at it versus the dollar index and see exactly how this is shaping up. You would expect the correlation to be inverse. So, yep, there we go. So we've got this very close correlation at the moment between the US dollar and gold. But what's notable here is we've bottomed out, we've rallied. That's what's happening with the US dollar, but we haven't broken out yet for gold. So that to me points towards a likely breakout for gold in the very near future. 5048 is your resistance level. But yeah, hopefully we'll get this video up and running as quickly as possible. But yeah, for me, I think it's likely we see another break higher for gold, reiterating or furthering the recovery that's been taking hold of late following these major jitters that we saw around that Warsh announcement. Certainly, I think those perceptions, the perception of quite how hawkish he's going to be will soon fade away. And like I've said a number of times, look at how he's treated Powell, right? I mean, you know, I don't think Trump's just going to not even mention. He said that, oh, we didn't discuss rates between him and Warsh. That is absolute nonsense. They would have discussed rates. He's promised him that he'll do, you know, he will be pro-growth. He will be on their side. He thinks disinflation is coming in a big way because of AI. You know, Warsh will cut rates, and he will perhaps be a better voice within the Federal Reserve to be able to make that happen compared to someone that comes in and is a massive dove historically. He's already been there. He was hawkish. Now he's telling people why they need to be dovish. Right. I've got a TV interview to jump on, so I am going to have to love you guys and leave you. But yeah, on that note, the way that we've seen that breakout for the US dollar, I think we're likely to see a similar kind of move coming into the fore for the price of gold. Thanks for joining me. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.